The stock market was down about 0.7% here today. This was actually the third straight down day for the S&P 500. We only had about 20% of the stocks in the index closing higher today. So all of a sudden, we're starting to see some of those postures shift back to bearish once again. So we'll take a look at all of that in tonight's video. We'll spend some time on some of our past trades as well. Tomorrow is options expiration for the month of January. And there's been a trade that we've actually had on for 2 years that we will lay to rest tomorrow with a 100% max gain. So we'll bid that one adieu. We'll also take a look at some of the asset classes out there. We've had quite a string of success with preferred stocks here recently. Bitcoin has also been on quite the roll. Then we'll take a look at the sectors where we have very few sectors that continue to have a bullish posture at this point. And then lastly, in our trade application example, I wanted to feature a lithium stock that I had never heard of prior to today that's setting up with a bearish divergence signal. So I wanted to practice a long put spread with that particular symbol. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 19th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area, and there you'll find an email distribution list link, and that would allow you to sign up for that list. So that way you can be notified whenever we post these videos. Also at the bottom of those emails, you'll notice that we give you the overbought and oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on our Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And we had yet another sell-off day here. As you can see, I've got the S&P 500 heat map pulled up in front of us. And clearly we have way more red squares and rectangles than green ones. A couple of the green ones do stand out. For instance, Google had a very good day. Remember, that was one of the few trades that wasn't going my way here prior to this week that I had an iron condor on and I needed it to bounce up a little bit. So that came just in the nick of time, as of course tomorrow is options expiration for the January contracts. But Google was the rare mega cap that had a very nice day of outperformance today, up about 2% there. We did see some green over in the healthcare world. We saw United Healthcare up about 1.7%. Bristol Myers was up just over 2%. Merck was up over 1%. So some pretty good activity there. I see Medtronic was up about 1% there as well. Of course, that's been a stock we've been not only focusing on in my dividend growth investing classes at Market Scholars, but we also currently have a sold put on Medtronic in this particular Market Outlook portfolio as well. So some of you might still have that trade on. And so far, so good. We're in the driver's seat on that one. I did see some news regarding healthcare after hours, however, and I did notice that Eli Lilly had some bad news on their Alzheimer's drug, and so their stock was down a bit after hours. This is not capturing that because this heat map only shows us what's going on in the normal market session, but I think Lilly was down about 3% after hours. And then on the flip side of that, Biogen IDEC was up quite a bit after hours. Remember, they're kind of competing with Lilly in the Alzheimer's space. Biogen itself was down about 1% in the normal session today, but recouping those losses in the after-hour session on that news from Lilly. So we'll keep our eye on the healthcare sector tomorrow. There might be some fireworks there. Of course, Alzheimer's has been a tough nut to crack, one that a lot of money has been thrown at, and we haven't really seen much progress with over the years. And there's maybe a little bit more optimism these days than there was perhaps 5 to 10 years ago, but we still have a long ways to go to cure that dreadful disease. And so keep your eyes on those two stocks in particular tomorrow, Eli Lilly and Biogen IDEC. In terms of other areas in the green, saw a little bit of green and bullishness in the travel space. So Booking Holdings, of course, that's a company behind Priceline. It was up about 1%. Marriott was up about 1%. Hilton was up about 0.5%. So a little bit of activity there. Probably what catches most of your eyes in terms of consistency of the green, you would look at the energy area. In fact, that might be a clean sweep there. Let me right click on that area and zoom in only on energy. Wasn't quite a clean sweep. We did have a couple of the oil field service providers, Halliburton and Baker Hughes, down just a touch. But other than those two, all of the other oil companies in the S&P 500 did manage to close higher here today. So that's the place that if you had a little bit of exposure there today, at least helped you out for the time being. Other areas of green today is much more sporadic elsewhere. We saw ServiceNow with a big day. It was up about 3%. Adobe and Salesforce managed to close in the green there. Visa had a small up day. Goldman Sachs was up a touch here today. I actually answered a question, I think, from Dennis earlier today in our question and answer session about a sold puts trade, which of course is a bullish trade on Goldman Sachs. And at that time, I'm pretty sure the stock was down. So it was nice to see that stock have a nice little rebound as the day went along. We also saw some green out of the tobacco companies. Philip Morris and Altria both ended up closing higher by more than 1%, nearly 2% in the case of Philip Morris there. In terms of the red areas, it's hard to kind of pick and choose because it's pretty prevalent whatever sector you look at other than energy. Energy, again, consistently bullish today, but pretty much all of the other sectors do appear to have just as many red squares as green ones. And so, don't need to pick on any in particular, but I suppose I could point out that industrials had a particularly bad day because industrials had been an area that, was actually performing quite well, but kind of feels like the last few days, the air has been sucked out of the room there. So keep your eye on that area. There's been probably some stocks that have gone up more than they deserve, right? Sometimes when companies get their mojo going, it is a pretty rude awakening once valuations get reset back to where they should be, right? A lot of times you don't notice that when you're in a bullish market environment, but you happen to notice it more when you're in a bearish market environment, or at least a choppy market environment like we have been here more recently. I would also point out that a lot of the consumer staples struggled today. Procter & Gamble did report their earnings here today, so that's why that stock had a more aggressive down day. It was down almost 3% here today. Remember, Procter & Gamble has done fantastically well over the years, and so I happen to think it's probably a little bit richly valued right now. This is a stock that we were buying in my dividend classes, 5 years ago when nobody wanted to touch it. People were throwing it away. And then all of a sudden here in the most recent 5 years, the stock has just gone up, up, and away. And now it seems like the world has kind of fallen in love with it. And of course, that's a time when you should be most concerned if you're looking at it, at least from a valuation long-term perspective, right? Traders can always attempt to get in and out based upon what they're seeing on the charts. But if you're a long-term investor, you want to scoop up the high-quality merchandise when it's on sale, not when it is just blistering hot to the upside. So wouldn't be surprised at all if we start seeing some of these higher quality dividend stocks that held up so well last year start giving back some of those gains, and then set up a new generation of dividend investors with acceptable prices, because last year we just didn't really see the aggressive sell-off in a lot of those aristocrat names like Procter & Gamble and Coca-Cola and the like. Pepsi. Saw a great post there on Twitter last night about somebody that was in the supermarket saying Pepsi owns all of this, and what they were referencing there was all of the Frito-Lay and the chips and the Doritos in the snacking aisle at Walmart. And some people are shocked to find out that Pepsi is much more than a soda company. They basically dominate the snacking division here in the United States. So, those companies did quite well last year on a relative basis, at least. And so they might have to give back more than others. So we shall see as the year moves along. Financials were kind of interesting today as well. We did have some financials that did very well. So a stock like Truist Financial was up 4% today. M&T Bank was up 5% today. Fifth Third was up almost 3% today. Comerica was up almost 6% today. So those were actually some of the bigger up moves in the S&P 500 today. But on the flip side of that conversation, you also had some of the worst performers in the S&P 500 today in the financial sector. Schwab, as one idea there, was down 6% today, and Northern Trust was down about 8% today. So it didn't seem consistent there. It just seemed like very exaggerated trade in both directions there within the financials. Also, one thing I should point out is that we're kind of getting into the heart of earnings season right now. And we did have quite a big one come out here earlier this afternoon or this evening, depending upon when you're listening to this presentation. But in the after-hours session here on Thursday, Netflix did report. And so anyway, with Netflix, of course, that is one of the original FANG stocks, and it might not have the pizzazz that it once did, or the heft that it once did, but it's still a pretty important company from a risk appetite perspective. And the last that I checked, Netflix was trading higher quite nicely. It closed the day at 315, and it is currently trading after hours at around 337. So as of right now, it looks like we'll have a nice little boost out of that important player within the communications sector tomorrow morning. So keep your eye on that one as well. All right, let's go ahead and take a look at our official breadth numbers. Coming on over here to the platform. And I've got the index watch pulled up with the S&P 500 public watch list to kind of apply it to. And as you can see up here, there were 114 stocks in the S&P 500 that closed higher here today. And so obviously a lot more stocks closed lower here today. 386 of them did. And so today was one of those days that it was clearly in the camp of the bears. And remember, this follows yesterday. Yesterday was a pretty ugly day. I was not with you yesterday. I think David did the video there last night for you. But remember, typically on days when the market is down more than 1%, if it is my time to do the market outlook video, I would be looking at selling some puts. And I was talking about that concept with my premium members earlier today in our Q&A class, and I was mentioning how I haven't had as many put sales in my own personal accounts here recently compared to big stretches of 2022 where it kind of felt like I was selling puts almost every other day is the way it felt because we had so many 1% down days in the market. But recently things have been pretty darn calm. I still have plenty of puts that will be expiring tomorrow like a lot of you, but most of those trades were put on back in, let's say, November or December. So far here in the month of January, I really haven't been doing much in that regard. I did finally sell some puts on a stock yesterday when the market was down more than 1%, but other than that, it's been a pretty calm year. In fact, a pretty bullish year for the most part. So, it'll be interesting to see if this, 2-day sell-off that we're in the midst of right now will lead to anything serious to the downside. But I think there's still work to do out there. It's kind of interesting listening to financial television because, of course, you're going to have people in the bullish camp, people in the bearish camp, and there are some people that are legitimately thinking in their head that we're through the worst of it and we're on to brighter days in the market. And while I don't know the future, and I certainly can't predict exactly what will happen in the future, I would not be as bold to say that we're out of the woods yet. I still think that we're in a more challenging position right now. In fact, those of you that have seen the market outlook trade applications that I put on this year, all of them have been bearish. I haven't put on a single bullish trade in our market outlook videos in the year of 2023 yet. I'm not opposed to doing so, but I'm just looking for the right setups. And my mindset is still one that I'm concerned about the future. I can acknowledge that there's been plenty of bullishness around, but I can also have a belief that it's not going to be quite as easy from this point forward, right? You're going to find plenty of opportunities to trade back and forth and things like that. And so, with the markets being up this year, I'm actually making money on all of those bearish trades that I put on so far this year. So, if you're picking and choosing your spots the right way, I think it can also work. Now, obviously, there's going to be plenty of times it doesn't work for you, and it doesn't work for me as well. But right now happens to be one of those times where all of the market outlook trades that I put on prior to today are making money right now. If we come over here to the monitor tab, if you look at this P&L open column right here, this tells you how much you're either up or down since you opened the trade. And all of these are positive trades except for the one that I just put on today. So with 18 minutes left in the market. And we'll talk about that at the end of tonight's video. So if you exclude that trade that I just did this afternoon, that's only been in my account for 18 minutes, all of the other market forecasts or market outlook trades that I've done are profitable at this moment in time. And by the way, with tomorrow being options expiration for the month of January, I should give a formal send-off and farewell to Kellogg. Some of you have been following that trade for quite some time. It was a very unique one, I must say, because I put this trade on way back in February of 2021, so nearly 2 years ago. So when I put that trade on, it was a LEAPS option, right, or a long-term anticipation security. Basically, there's a certain type of option out there that you can do for years instead of the typical months that you see David and I talking about here. So we had kind of a unique one way back then, and I'm sure you could still find the YouTube video if you wanted to go back and listen to my presentation on it on that day, back on February 11th of 2021. But the idea was to sell a put on Kellogg at the $50 strike price, because I felt like that was a pretty high quality dividend growth company that was being unfairly punished at that time. And because we were willing to be in the trade so long, we actually got a very juicy premium out of it. You can see that we're making about $627 out of that, and our P&L is at 99.6% capture rate, which basically means tomorrow we will hit our 100% max gain once they officially expire worthless. But just to remind you of where Kellogg was back then, let's go ahead and pull up like our normal dividend stair-step chart here, and pull up ticker symbol K for Kellogg. And let's go back to where it was February 11th of 2021. It was basically right here. Now remember, these are weekly candles, so this is the week of that trade that I placed. And you can see that week, I'm sure if you go back and listen to my presentation that day, I probably was talking about how it had a very rare oversold weekly cluster. That's what that little green dot on my chart signifies. And you'll notice we didn't have to sweat that trade a single day. So those are the types of trades I want more of, right? And obviously they're hard to come by. But when you're in a trade for years and you're never concerned about losing money on the trade, you're doing things pretty well there. Because remember, we sold the $50 put, which would have been actually lower than where Kellogg had traded in this entire decade. But because we had done it at a time when everybody was panicking, remember, Kellogg was just falling off of a cliff here. People who are looking at charts would have said that's the ugliest chart around, because you're basically seeing nothing but negative momentum. But remember, sometimes it's so bad it's good. And that's the way us dividend growth investors try to train our brains to think like. It doesn't always work. Nothing works 100% in this business. But this one worked beautifully. Where we had the oversold weekly cluster, we decided to play a little experiment with it and say, hey, let's try to collect a bit more premium up front with this one and do a LEAPS contract instead of just going out our typical, let's say 30 or 60 days, something in the near term, and collect a little bit more money. Now, obviously, it does tie up our money along the way, so that's the flip side. There's always pros and cons to all of these decisions that we make, but I was quite pleased with how this one shook out. And obviously, it's had its day in the sun, and it's kind of rolling over a little bit here more recently, so I'll keep my eye on it, and if it gives us another oversold weekly cluster, who knows? Maybe I sell another put on it. It is a little different these days, I will admit, because back there in February of 2021, We didn't know at that time of their spin-off plans. Since then, they've come out and announced that they're going to basically break up into 3 different companies. So that starts to complicate matters a little bit more there. But all in all, it was a nice, fun experiment there with Kellogg. And yeah, we tied up our money a little bit, but hey, we've got an extra $600 in our pocket today because of our willingness to buy a boring old cereal company during a period of time when many tech stocks are getting annihilated. So sometimes it's nice to stick with the tried and the true in this business, and I think Kellogg fits that role pretty nicely there for us. All right, let's go ahead and get into our normal routine now of taking a look here at our 4 grid. So let me pull that up. This is chart 4B for those of you that are following along at home. And as you can see, it's been, pretty ugly couple of days. For most of these indices, it's actually been a 3-day sell-off. For the NASDAQ, it's just 2 days. Nonetheless, it's been a pretty aggressive move across the board here, and aggressive enough where you'll notice that we do have some posture changes here to talk about today. The S&P 500 has now gone back to a weekly bearish posture. You'll also notice that where the S&P 500 closed was just a hair below its falling 30-day moving average. It's hard to see that with the naked eye right here, but we know that because the moving average itself is now painted red, as you can see here. Yesterday it was yellow because yesterday it still closed above that moving average, but today it closed slightly below that falling 30-day moving average. Be aware that that is also the case with the Dow Jones Industrial Average. So both of those now have weekly bearish market forecast intermediate postures, and both of them are now trading back below their falling 30-day moving averages after spending some decent time above it, in the last couple of months. We talked about in my presentation on Tuesday about how the Russell 2000 has seemingly taken the leadership role away from the Dow Jones Industrial Average here. And this has all happened basically within the last week and a half. And today, I'm not changing my mind on that stance. You'll notice the Russell 2000 was up so far above the moving average that, yes, it can have a 3-day sell-off like it has, just like the Dow Jones has. But because it had so much upside prior to it, it's still in a reasonably strong position above its moving average right there. So there has been more wear and tear on the Dow Jones here recently. And it kind of ties back into what I was mentioning here just a moment ago on the S&P 500 heat map with, a stock like Procter & Gamble getting hit pretty hard here today, right? That's kind of your traditional blue chip that would be in the Dow Jones Industrial Average. And those types of companies are getting hit more right now. Some of you will recall that my Roth IRA, my personal Roth IRA, which is my biggest account and the most important one for me, was actually up last year. I know a lot of people have a hard time believing that, but it is true. Scout's owner. It was up last year. Now, on a price basis, it was actually down just a touch, but when you include the impact of the dividends, it actually was higher value-wise than it was the prior year. And that was not an easy feat. Obviously, most people were not able to claim that. But last year was a year where the dividend growth investor truly shined. And even the dividend aristocrat list was only down like 7% last year when the NASDAQ was down 33%. So there were dividend investors that made money last year. I know that may sound hard to believe, but it is true. Now, that's the good news. I'm happy to report that. Here's the bad news. I've been doing terribly this year. So I'm actually down in my Roth IRA right now on a year-to-date basis in 2023. Now, obviously, we're only 19 days into it, so there's no guarantee that's going to continue, but it is kind of interesting to me, just fascinating to watch it play out. Now, obviously, I'm a long-term investor, so it's not like something like that's going to either push me into or out of the market. I just find it fascinating that last year, sitting tight in all of my dividend growers really proved to be quite a good strategy for me. This year, it's the reverse. A lot of those really high quality companies like your Procter & Gamble's and your Pepsi's and some of those, they are underperforming right now. I even noticed a day last week where the market was up and my account was down on that day. And that's very odd, for my own portfolio. Typically, like a lot of you, if your portfolio is diversified enough, if the market is up, your portfolio is up. And if the market's down, your portfolio is down. So it's been kind of interesting that I've sensed a little bit more wear and tear in the dividend growth investing strategy so far on a year-to-date basis in 2023. And if you've been following me in my premium classes at Market Scholars, you'll know that that is not coming as a surprise to me. Because I did so well last year, and a lot of our other dividend growth investors also did at Market Scholars, I've been trying to train their minds and prepping them accordingly that we may need to give back more this year as a result of that. We out-earned our potential last year, and we probably didn't deserve that. And this year we might have to give back some of those good graces that the market was willing to give us last year. So I'm preparing myself accordingly for that. I'm not expecting to outperform the market this year as much as I was able to last year. If I'm wrong about that, I'll be pleasantly surprised, but I don't think that, things grow to the sky. And, I was mentioning to my students here, I think it was last week, something caught my eye in the morning. Usually before I go into my premium classes, I turn on CNBC, and Bob Pisani was on there, and my ears really perked up because he started talking about the dividend aristocrat list, and I'm like, wow, okay, now the dividend aristocrat list is hitting Main Street media, right? And usually by the time something gets talked up to such a degree that your average person on TV is talking about it, usually the cat's out of the bag too far. And oftentimes those are the Johnny-come-latelys that will end up suffering as a result of that. So, always just want to be upfront with people in that regard that, yes, cycles come and go. We were blessed last year as dividend growth investors. This year, we might not be blessed quite as much, so prepare yourself accordingly. But that whole conversation plays nicely into what we're seeing with the Dow Jones Industrial Average as well. Remember, if there was a leading index of these four in 2022, it would have been the Dow Jones Industrial Average. That's where you're going to have your Procter & Gamble's and Coca-Cola's and those types of companies that are oftentimes dividend growth companies. But so far this year, I would not categorize it as an outperformer. You'll notice that the Dow is now down this year. I actually didn't notice that until I'm speaking with you right now, so maybe I don't have to feel so bad knowing that my own Roth IRA is down this year. The Dow's down this year as well after this 3-day sell-off. Just barely, not by much, but it is down just a hair. Here's the, maybe I could zoom in by right-clicking and maximizing this. This was the closing candle on the final day of 2022 right here, and the closing price was 33,147. And so we are currently trading about 100 points lower than where we were on that day. So even this, you don't have to take my word for it that some of the tried and true blue chips are struggling right now. You can see it directly with your own eyes right here, right? It looked pretty good there for a while, but this last 3-day pullback has been pretty vicious for some of the highest quality companies out there. Whereas you kind of take that same concept and then you apply it to what some would perceive as the lower quality small cap universe, and we cannot make that claim. Notice that right here, this candle right here that I'm circling is the final candle of 2022 for the Russell 2000. And notice where we're trading right now. We are way up still on the year on the small cap universe, even though the Dow Jones Industrial Average is now down on a year-to-date basis. So it has been a very interesting start to the new year, and what it seems to be is taking place is part of it is risk appetite, where the market's a little bit more comfortable all of a sudden with things like Bitcoin and other stuff like that. But another part of the story is I just think some of those big blue chip companies got a little too overvalued, a little bit too over their skis last year, and now you're kind of having to kind of balance the scales a little bit by giving some of that back. So we'll see if that continues to be the case moving forward, but that certainly caught my eye so far here early in 2023. Just to put a ribbon on it, the S&P 500 was down 0.76% today. The Dow was also down 0.76% today. The NASDAQ nearly matched it identically by being down 0.96%, and also the Russell 2000 was right there in that exact same neighborhood of 0.97%. So today they were all down there, not quite up 1%, but nearly 1% across the board. And 3 out of these 4 charts now have this pink background color telling us that they have weekly bearish posture. So that's the S&P 500, the Dow Jones, and the NASDAQ composite. So that means that the Russell 2000 remains our leader in this market. Even though it was down just a touch more than the others today, it had gone up so dramatically in the first part of this year that it can afford to give a little bit more back there and still maintain its strongly bullish posture here, and obviously is still trading well above its moving average. The NASDAQ is still trading above its moving average as well, but notice that it's pretty close to it. If we have another bad day in the market tomorrow, the NASDAQ could easily close below its moving average, whereas I would personally be shocked if the Russell 2000 closed below its moving average tomorrow, because that's a pretty healthy gap right there. So for the time being, it's the same thing that I told you guys on Tuesday. In my head, the Russell 2000 is the new leader of this group. By the way, although I don't expect the Russell 2000 to close below its moving average tomorrow, I would expect that there's a pretty decent chance that it could go to a weekly bearish posture and joining these other 3 charts. The reason I say that is notice that the green line, so let me right click and zoom in here so you can see it a little bit better. Notice that the intermediate line on the Russell 2000 is actually going a little bit lower right now, but remember, we give it that grace period. As long as it's in the upper reversal zone, which means it's above 80, we don't care if it's going up or down, we would consider that to be bullish. But if it does fall out of that upper reversal zone, then it could start giving you more bearish conditions there. You know, we wouldn't call it strongly bearish, but starting to show up a little bit more bearishly. And since we're at 81 and falling right now, remember, it just has to get below 80. So, you know, if we have another sell-off day tomorrow, it wouldn't surprise me in the least if the Russell 2000 also ends up printing a weekly bearish posture. But again, I'm not anticipating such a terrible day tomorrow that we end up seeing it below its moving average. It's going to have to require a much more aggressive pullback for that sort of thing to occur. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support our presentations here, and the best way that you can do that is for us here on Twitter. I just have to laugh for a moment. I was just speaking about Bitcoin a moment ago and how well it's doing this year. Some of you will have to check out this video of Bob Barker that I tweeted on my account. You can see his exasperation in him doing his job and the frustration that he had with his contestants in one of the games that he had there. So if you're interested in that, check out my Twitter feed. But otherwise, remember, on my Twitter feed, you can find pin to the top. So every person that's on Twitter can pin a tweet to the top if they want to. They can only do that with one tweet. But what David and I tend to do is, after we do our market outlook video, we will pin that specific tweet to the top of our timeline. The intention of that is to make it easy for you guys to click like for us, right? We don't want it to make it a chore for you guys to do that. We want it to be as easy as possible. And for many of you, you can do it within 5 seconds, because you can either do it directly here at the top of our timelines and finding our pinned tweet, or you can do it by clicking like on the little widget underneath the video that is playing on our website. You can also find the tweet in question in the description area of the YouTube video for those of you that watch these videos directly on YouTube. And then last but not least, you can find the tweet in question by clicking the Twitter icon in the emails that we send those of you on our distribution list. So either one of those 4 ways will get you to the same point. And I want to say thank you very much to all 122 of you that clicked like for me the last time around. That's actually a pretty good result for us. A lot of times my likes hover right around 100. And so when we're getting up there above 120, that means you guys are really going to work for me, and I really appreciate that. As I always say, as long as we're up and over 100 likes, I'm happy to do a full-length video that includes, hopefully winning trade ideas like we've had so many of recently. Can't always guarantee that or promise it, of course. There will be plenty of losing trades eventually as well, but we've been hitting it pretty nicely here lately in that regard. So I'm glad to see the acknowledgement from those of you that are willing to support us by clicking like there. So let's give some shout outs here to the 122. Thank you to Ram. Thank you to Brian. Thank you to Leo. Thank you to Margie. Thank you to Brandon. Thank you to Thomas. Thanks to Aviva. Thanks to Ash. Thanks to Jean. Thanks to Sandeep. Thanks to Nina, to Christopher, to Sherry, Lucius, Michael, Doug, Claire, Tokyo, Red Bull, Bob, Jim, Bernard, Shanoza, Christian, Roger, Paul, Austin, and others. There's a lot more of you to go. I don't want to skip over you, but I just don't have enough time to rattle off all the names. But the point is, every so often it's kind of fun to see your name in the spotlight, I suppose. So it's nice to give you that acknowledgement as well, because we do ask you to go out of the way to support these free videos, and you guys have done a great job of that here recently. So please keep that up, and thank you very much. Let's also have a little bit of a chat here about the factor selector tool. And so this is something that I update on Tuesday nights, but then I post it to our website on Wednesday mornings in preparation of my factor-based swing trading class that I teach on Wednesday mornings. And so this is a couple of days old right now, but can still give us a general idea of what's taking place from a factor perspective. And remember, this is different than what I showed you in Tuesday's video when we talked about the sector selector. This is the factor selector. And so it's kind of giving us maybe some different insight here as we look at the performance metrics of different parts of the market that are out there. And as we look at this, it should come as no surprise that low size is now number one, right? We've been talking about here in the last week and a half or so how low size has basically gone straight up, or at least the Russell 2000 has, up until this 3-day sell-off that we've had here recently. So no surprise that the low size factor is the one that is most closely aligned with the small cap index of the Russell 2000. And so with the Russell 2000, taking names out there, so to speak, and kicking butt over the large cap indices here recently, it's no surprise that the low size factor is doing the same thing to these other kind of larger cap factors that are out there. So low size is basically confirming what we've already been talking about in these videos for the last couple of weeks with the Russell 2000. And notice who it supplanted up at the top. Dividend yield was number one last week, but it fell all the way to number 3, and that plays right back into that conversation I was just mentioning with you a moment ago about how my dividend stocks are struggling so far in 2023 compared to the good graces I received in 2022, and this is kind of confirming that information there as well. Now, this isn't exactly the same thing that I do because I'm more of a dividend growth investor. This is more pure dividend yield, but there is a lot of overlap between those two approaches, and I think this is accurate. This is basically reflecting what I'm witnessing anecdotally, that this year has been a tougher year as we've started off 2023 for the dividend community compared to what we experienced last year, especially on a relative basis. On the flip side, in other words, at the bottom of the graphic here, you will see that momentum stayed at the bottom for the second straight week. Momentum is effectively, you can think of it like trend trading, right? It's basically what stocks have the hottest stock prices, and does that strategy work after you get into the stocks after they've gone up, right? All of us want to be in momentum stocks, but we wanted to have bought them a long time ago when they were out of favor, right? But there's a whole other crew of traders out there that they don't care that others have bid those stocks up. They want to jump on that trend and try to ride it as long as that trend will allow. But what we've been noticing in some of my classes at Market Scholars is trend trading has not been particularly kind to traders here in the last year or so. It seems like more often than not, by the time a trend gets established and a stock is breaking out to new highs, that's when you're starting to see those trends give up the ghost. In other words, you're far better off in most cases, at least here in the last year, having bought a stock whose chart looks terrible and whose stock has sold off to make the business more attractively valued in the hopes that that does get a bounce higher, as opposed to the opposite, having that FOMO or that fear of missing out and chasing a stock higher after everybody else has already chased it higher before you, and then you end up being the bag holder. So momentum has not been a particularly good place to be hanging out here in the past year, but of course things change, right? Things are cyclical. At some point when there's more liquidity being injected into the system and the Fed starts pivoting and animal spirits are back and alive and well, and more IPOs and SPACs and all that kind of cryptocurrency stuff, when all that comes firing back, I'm sure the momentum category will do pretty well in that environment as well. But for right now, the market is just very, very cautious around that idea. The market does not want to reward people for doing the easy thing and buying a stock after everybody else already has. The market is more willing to reward people doing the hard thing and buying stocks that have gone down in price with the hopes of getting some sort of a rebound along the way. So remember, every market environment is different, and that's the whole point of us evaluating the data that we do in my classes, like with this factor selector here, and helping us guide our decisions in our various classes as well. Notice, by the way, low volatility is also struggling. It's been down 2 weeks in a row here. Remember, low volatility has a lot of utilities in them. And when I was with you on Tuesday, you'll recall that the only two sectors that had bearish postures were the staples and the utilities. The staples, much to my chagrin, because it's my personal biggest sector as a dividend growth investor. I also own plenty of utilities, but not nearly as many as I own in the staples. Regardless, both of those areas are known as very boring areas, and the more boring the business, the more likely it is that they would be qualifiers for the low volatility category of stock. And with those two out of favor right now, compared to some of the other cyclical areas, then low volatility is now struggling as well. So, if we start getting a major sell-off again later this year, right? We've had a 3-day sell-off that we're in the midst of right now, but it has not been aggressive like to the degree that we saw so often last year. But if things do get out of hand again this year, which I'm personally anticipating, then I would venture to guess that low volatility will be able to work its way back up in the graphic again, because while utilities might still go down, they probably won't go down as aggressively as something like, I don't know, consumer discretionary or technology or some of those types of areas. So for right now, you're kind of in that no man's land, but that's what I'm on the lookout for as we move forward. All right, let's go ahead and pop back on over to the platform now, and let's do some 12 grid analysis. So we'll start off here with chart 5A, and this is our asset class 12 grid. And a reminder that the asset class 12 grid will show us not just stocks, but things like commodities and interest rates and Bitcoin and foreign stocks and different things like that. So, it's rare that we would see a clean sweep of either all bullishness or all bearishness on this first set of 12 grids. And right now, you can see that the bottom two corners are the two corners that have the pink charts. What that suggests is that the current market forecast intermediate posture on those two entities are bearish, whereas all the rest of them would be considered strongly bullish, with the exception of the S&P 500. Notice that its chart is light pink, so its shading is lighter than the darker pink that you see with these bottom two. So this one in the upper left that represents SPY would be considered weakly bearish. These other two are strongly bearish, and then all of the other charts are what we would call strongly bullish at the moment. It's kind of interesting because, for much of last year, we saw that the bottom two corners were the ones that were green when most of the others were pink. And right now we're seeing the opposite of that. And so who knows when that changes, but it's been kind of a little bit of a relief to the stock market, I have a feeling, to see both treasury yields and the US dollar slipping. That's basically provided more fertile breeding grounds for the more speculative securities out there. Remember, especially when the US dollar is down, the foreign stocks can do quite well. And so EFA and EEM have been, smashing successes here over the last 3 months. And, that's benefiting from both a falling dollar and falling interest rates. However, be aware that the interest rates now have fallen so much. Let me right click and zoom in here so you can see this, that we have what's known as an oversold cluster signal on TNX. So this is basically tracking the 10-year interest rate in the United States. And you can see that we've got this little green dot showing up that signifies that all three of our different colors on the market forecast, the green, the blue, and the red lines, are in the lower reversal zone on the same day. So it is possible we get some sort of a reflex rally coming out of that, but judging by what we saw back here, it wasn't all that lasting, right? We had a couple of days in a row with oversold clusters here, which did lead to a couple of days of rally, but then you had this big, gap down after that, and you had a couple more, and then you had this big rally, but that failed as well. And then eventually we had this really big sell-off right here, and that led to a much more substantial rally after that. So who knows what will be in the works for this one, but it would not shock me at all if we do see TNX at least work its way back up towards that falling 30-day moving average. So put that on your radar, whether it happens tomorrow or early next week, who knows, but that's something that I'm going to be keeping my eye on right there. With a lot of the other charts, as I mentioned before, they were quite bullish. One stock or one chart that I've been highlighting quite a bit for the last 2 or 3 months has been gold, and here we are yet again. This thing just keeps ripping higher. So I know I sound like a broken record, but it's because it keeps working, right? It's one of those things where don't fix what ain't broken type of a mindset there. So if you're playing the gold miners or gold in general, I see no reason to stop playing that game right now, right? And we even have a position in this market outlook category right now with that bullish trade I have on Newmont Mining. We've also looked at the junior gold mining ETF in my trend trading class. And so some of you might have had some exposure from that as well. But, regardless of where you're coming up with your ideas, if you're in the gold market right now, it has been a brilliant trade, and it really has come with very little drawdowns along the way. Those are the best kind, right? Because most trades, once you get into them, they'll make you second guess your decision at some point in the life of the trade. But for the most part, this has been a calm rise in gold, and it has been long-lived as well. Remember, we've been talking about this since going all the way back here to November. So we're talking about several months at this point, or at least a couple of months at this point, of upside action with very little in the way of downside give back. So it's been really, really impressive to me, and it even emboldens me more. So now it's to the point where I want it to pull back because, it's kind of confirmed to me that I should have been bullish, right? I'm glad that I was, bullish to the degree of putting on the Newmont trade, but now I almost want to put on more of those types of trades. But because this thing is, kind of a runaway freight train right now, I'm a little bit hesitant doing that way above the moving average. So what I'd like to see at some point is for gold to roll over, but not aggressively, only roll over and then establish kind of a new launch pad above its rising moving average. And if that happens, do not be surprised if I bring you more bullish gold ideas during these videos at that time. But right now, I'm just a little nervous that if I try to get too bullish up here, I might end up, burning my fingers on the hot stove, so to speak. So I'm going to try to be a little bit more patient with that. That might not be the right idea, by the way, right? I don't have a crystal ball, so who knows? Maybe this just keeps on going, and I'll regret looking back not having been more aggressive. But I also have to kind of stick to my knitting, so to speak. And I've never been a guy that likes to chase stocks. And so I'm going to be waiting in the wings. And if we get some sort of a pullback in gold, then anticipate that I'll be bringing some more bullish trade ideas to your attention during these videos here. So gold had a great day. It was up 1.59%. Of course, it remains with its strongly bullish posture. Oil also had a pretty reasonable day. It was up 1.55%. It also has a strongly bullish posture. However, the chart in my eye does not look nearly as appetizing as gold. Gold has just been, a thing of beauty here, whereas the oil chart has been more chop and slop, right? It hasn't been just a complete wreck to the downside, but it hasn't been a beautiful chart to the upside either. So there's just work to do there, and it's been a little bit harder to make sure you're on the right side of the oil trade. Whereas gold, it's been pretty easy. It's just been a layup, right? As long as you've been buying gold or gold stocks, you've been hanging in there like a champ here in the last couple of months. In terms of this middle band here, you can see most of these are our bonds, and bonds do remain in bullish territory despite all three of those categories selling off today. Long-term U.S. Treasuries were down 0.63%, foreign bonds were down 0.1%, and then high-yield bonds were down 0.59%. But again, they all maintain their strongly bullish posture, and with long-term U.S. Treasuries and high-yield bonds, they both also have rising 30-day moving averages that they're trading above as well. So there's been some pretty good bond activity there. We've been talking about bonds quite a bit more in my question and answer session here lately, as I've been sharing my experience with students in regards to me being in the U.S. Treasuries in the 3-month category, so that would be the Treasury bills. For the last 11 weeks, I've participated in those auctions, and so it seems like that's an area that's generating a little bit more interest recently because prior to last year, they didn't really offer much in the way of legitimate income. But with the big sell-off in the bond market last year, they've become a lot more appetizing because, of course, most of you are aware that when bond prices go down, their dividend yields go up. So at the end of last year, they became much more appetizing than they ever had for many years prior to that. And we're actually seeing pretty good stabilization in those bond charts right now. And I still think many of them offer interesting income opportunities at this moment. I'll always be a dividend stock guy at heart, but I also am not going to pass up free money if the U.S. government's willing to give it to me, especially in the 3-month category. Remember, the 3 months is just ridiculous right now. You can get 4.7% interest rates on the 3-month U.S. Treasury bill. You can't get that on the long end. That's why we have the inverted yield curve right now. But in the short term, you can get some pretty juicy yields where you have very little risk of default, right? Unless you think the U.S. government is going to implode or something like that. It's very safe in terms of you getting your money back and them giving you a at least rational reward along the way, as opposed to the irrational rewards that they were trying to give investors over the years when interest rates were down there at like 0.1%, right? So the bond market has been much, much more interesting to me here in recent months than it ever has been in the, quite frankly, 24 years that I've been an investor and a trader. So who knows where that takes us, but I would expect that the bond market has a pretty decent chance of outperforming the stock market this year, and I think gold does as well. In terms of the foreign stocks up here, the EFA, so this is the developed foreign stock markets, we're down just a hair here today, but notice that they did outperform the U.S. market today. And then the EEM, which tracks the emerging foreign stocks, they actually went up today. So I mentioned this on Tuesday as well, but for those of you that didn't watch the video, look at the difference between the foreign stock markets and the U.S. stock market. U.S. stock market is up 5.47% over the last 3 months. Now, that's not terrible. I think most people in most 3-month periods would be happy to get 5.5% returns. Remember that the expectation on a whole year is somewhere between 8 and 10%. So for the most part, most of your 3-month periods throughout your investing career, you'll be happy to receive 5.5%. But then you compare that to what the foreign markets are producing, and this has been just absolutely stellar. Take a look at EFA. It's up 23% in the last 3 months. That's a home run. Take a look at EEM. It's up 19% over the last 3 months. That's also a home run. Those things have just been ripping it to the upside. So it's been kind of cool to see that, because I know the U.S. markets have kind of stolen the thunder from a lot of the foreign markets over recent years, and it's probably time for those foreign markets to start outperforming at some point moving forward. And who knows, maybe we're in the midst of one of those types of upheavals as we speak here right now. I talked a little bit about preferred stocks on Tuesday simply because of the extraordinary nature of their win streak. I think it was, if I counted right, I think it was 12 days in a row. Probably would be 13 now. After yesterday, it went up again. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days in a row. Preferred stocks went up. Today, it was exactly flat. So that's why it's gray. I know it's hard for you to see if you're on a small screen. So if I blow that up a little bit more, when the background colors or the outlines of the candles are black, that means that the stock closed higher than where it closed the previous day. This is a rare gray background when I hover my mouse over today's candle, and what that signifies is it was an exactly flat day. Yesterday, PFF closed at 32.87. Today, it closed also exactly at 32.87. So if some people thought that they were going to end their 13-day win streak with a violent massacre to the downside to offset some of those gains, they were probably disappointed with today. Yes, the win streak is gone now, but it ended with just a neutral candle. And so there's been a lot of very interesting strength there in the preferred stock world, which doesn't always get a whole lot of press, but nonetheless is worth investigating every so often. Also, I should point out that Bitcoin had a pretty decent day. You can see Bitcoin remains up here near 3-month highs. Bitcoin has had an extraordinary move here in just the last week and a half or so, and has had a great 2023 so far after having an absolutely horrible 2022. So Bitcoin on a rolling 3-month basis is actually up about 10% all of a sudden. So I know a lot of people have been burned in that area over the last year, but for those survivors that are out there, you're starting to see a little bit of sign of life there in Bitcoin all of a sudden. Let's go ahead and now take a look at our sector breakdown, and this will be chart 5C. And as we pull this up here, you can see that we only have 3 green charts left on the board after this 3-day sell-off that we're in the midst of. The 3 that remain are communications, energy, and real estate. Both communications and energy, by the way, managed to close higher today. And remember, communications has a decent chance of doing it again tomorrow with Netflix up so much after hours here tonight. So, communications, as I was speaking with you on Tuesday, remember, it was way up on the sector selector tool compared to last year when it was oftentimes dead last. Communications has made a big move here in the last couple of weeks, where it's no longer the worst performing sector. In fact, it's trading closer to 3-month highs than 3-month lows. So it's been kind of sneaky hot that not a lot of people have been talking about. Energy, of course, everybody's been talking about for the last year of being hot. So, not as big of a surprise in that case. It's basically just doing its best to maintain, right, at this point, its strength that it had last year. But keep this in mind as well. If we go forward and we have a really difficult stock market year and risk appetite leaves the scene once again, eventually they'll probably come for the commodities as well. It's just the way that, intermarket analysis traditionally works. It's not a guarantee because every market moment is different, but, some of you recall what happened in 2008 and 2009. Oil stocks were the hottest thing around. And then eventually oil prices were kind of the straw that broke the camel's back, and the whole system imploded to the downside. And oil stocks had kind of a delayed effect and eventually chased the rest of the market lower. So that could very well happen this time around as well. So let's keep our eye on that as we move forward in 2023. I'm not sure that's going to start right away, but at some point down the line, a lot of times you will see that type of behavior play out. In terms of who today's worst performer was, it looks like it might have been industrials. They were down 2.06% today, and you can see they've broken down pretty aggressively below their falling moving average right now. I should also point out real quick so that you know that it's not just the whole woe is me routine that I'm giving you when I'm talking about the staples doing so poorly lately. There is a little bit of ray of sunshine here, and that ray of sunshine is it's so bad it's good. There's been enough of a sell-off here in consumer staples that we've now plotted that green dot there, in other words, the oversold market forecast signal on a daily candle chart. And so maybe this will tell us that, hey, we've gotten a little bit too bloody to the downside. We probably could make a little bit of a move higher. I'm not sure if it's going to be a trend changing type of move. In fact, in most cases, I would assume that it's not. But this was a really ugly candle yesterday. I mean, that was just consumer staples getting clobbered, which is rare for them. And so things might have gotten a little bit overdone to the downside in the short term. So we might be due for a little bit of a dead cat bounce or a relief rally in the consumer staples now that they have a very rare oversold cluster signal. Remember, they don't get those very often on consumer staples. Like if we went back, let's take a look at a 1-year chart here. You can see it does it when it's selling off over here. It does it when it's selling off over here. It does it when it's selling off over here. And it does it when it's selling off over here. And this is probably many more clusters than you would normally see in a typical year, right? If you would go back in other years and look at something like, I don't know, like a 5-year daily candle. If you look back here, there were stretches of time where they were almost non-existent. In fact, what's kind of interesting about this time that I'm zooming in on right here, this was from about 2019, start of 2019 until the end of 2020. So think of this as basically 2 calendar years right here. And this was during COVID. That's what that sharp drop was right there. Notice there wasn't a single oversold cluster signal on XLP during that 2-year period. So there can, be long stretches of time where you don't see that type of behavior at all. And we're currently in the midst of one of those more aggressive sell-offs right now in consumer staples. All right, let's go ahead and talk about our trade application example of the day. This one is going to be a company that many of you probably are not familiar with. In fact, I myself was not familiar with it before today. But as I was going through charts and things like that, looking for trade ideas, this one I kind of stumbled across and it caught my eye. This is Sigma Lithium, and the ticker symbol is SGML. It is a smaller company and one that I will warn you of right out of the gate before we even start the conversation, is not very liquid in the options market. In fact, I wanted to short sell this one instead of doing something in the options world, but unfortunately, you can see over here it says HTB on the platform, and if you hover your mouse over it, it says hard to borrow. So you can't place short selling trades on paper money, at least. When you do that on real money, sometimes you can call your broker and ask them to locate shares for you, but you'll either see an ETB, meaning easy to borrow, or an HTB, meaning hard to borrow. And if you like to short sell stocks, then you're going to have to keep your eye on the hard to borrow category. So instead, what I opted to do, as you can see down below here, is I bought a put spread. So remember, I'm not selling a put spread here. If I were selling a put spread, it would be a bullish strategy. In this case, I'm buying a put spread, which is a bearish strategy. It also means that I'm more directional on this particular security than I would be with other types of trading setups out there as well. So what I ended up doing was the 30-25 February long put spread. So I'm long the $30 put, and then I'm short the $25 put. And so the idea here is that you want the stock to go lower, and this blue line that I've plotted here represents my personal break even, because I had to pay $1.80 out of my pocket for that. Remember, when you're selling put spreads, you're usually getting a credit. When you're buying put spreads like I did here today, I have to spend a debit out of my pocket to start that trade. My best upside potential in this is about $5, and I had to pay $1.80 to try to access that $5. So the other way you can think about that is the profits that you could extract out of that would be $3.20 per contract. That would equate to $320, and that would happen if this stock were to fall below 25 and stay below it on expiration day. So that's why I said before, I need to be directional here. When I'm selling spreads, usually you can get away with just having the stock go sideways and you're going to make money on the trade. I can't have that happen in this case. I actually need this stock to fall in order for me to make money on this particular trade. The reason I like this one in terms of the chart is it did have a bearish near-term divergence signal. Notice that you have a peak in the near-term blue line right here. You have a follow-up peak right here that is lower than that other peak. So you have a lower high on the blue line down below, and at the same time, the two candles associated with those two levels would be this candle right here and this candle right here. So you have higher highs on price, lower highs on the indicator down below, which can sometimes tell you that there's danger, hiding in the bushes, so to speak. You can also see that this stock has obviously been a market underperformer, so the S&P 500 dotted line is well above it. You can also see that as of today, this stock transitioned into a bearish near-term posture with that pink background color there. You can also see that where this stock closed today, it closed below its falling 30-day moving average, which is now colored red. You can see that it's struggled and been down about 11% in the last 3 months. And then the other thing that I noticed is this was not the only lithium-related stock that showed up on my watch list today. I also found a couple of others that I was close to looking at for a trade idea. One of them would have been Piedmont Lithium, ticker symbol PLL, which also seems to be kind of struggling up here at a resistance area. And then if you looked at the ETF LIT, this is actually an ETF that looks at purely lithium-related companies. And you can see kind of the same formation here where you had a pretty aggressive sell-off over here where you plotted all these oversold cluster signals. You got that dead cat bounce, and now it's starting to look like it's failing over here. And remember, this is all happening at a time when Tesla as a stock is doing quite poorly, or at least it had been, right? Tesla is in the house of pain here as well. And so you'd have to believe that lithium-related companies are probably going to kind of fall in line with whatever Tesla itself is doing. So if you still think that Tesla is going to be bearish from this point forward, you might also be saying that lithium-related companies, of course, going into the electric batteries of those Teslas, would also struggle from this point forward. So anyway, it's going to be a little bit of a dicier situation because, again, it's not the most liquid company out there in terms of that SGML of the trade application example, but I think the chart setup is a very interesting one nonetheless, so willing to give it a shot. As I mentioned before, I would have preferred to short sell this, quite frankly, where there's plenty of liquidity on the common stock, but that was not an opportunity here in this particular case because it was hard to borrow. So I basically had to force myself, if I wanted to take a bearish trade on this one, I had to do it in the illiquid options world, and that might come back and sting me in the end, right? So we have to acknowledge the truth of that situation as well. But at least the chart seems to make sense to me, putting on yet another bearish trade. So like I mentioned earlier, all of my trades so far in 2023 have been bearish trades. And so we'll see where this takes us moving forward, but we're certainly balancing the scales there in the portfolio and have plenty of bearish trades to work for us just in case this market continues to sputter like we've seen for the last 3 days. Okay, so that's what I had for you here today. I hope you enjoyed the presentation. If you did, as always, I have one very simple request to ask out of you, and it only takes 5 seconds out of your time and doesn't cost you a penny. All I'm asking you to do is click a button on the internet. How about that? Trade your 5 seconds for my 3 hours that I put into these videos. And if you think that's a pretty good trade-off, then that's the easiest way to support it, is just simply clicking like for me there on Twitter. As long as we're up and over 100 likes, by the time I'm scheduled to do the video again on Tuesday, I'll be happy to deliver yet another full-length video like this. If we're under 100 likes, then I just plan on doing just a quick hitter 15-minute video on just the indices themselves. So that allows you guys to kind of dictate collectively what side of the coin we fall on there. So whether you do that or not, I appreciate you checking out the video here tonight. I want to wish you all a great weekend as well. David should be back with you tomorrow, and then I'll see many of you bright and early on Monday morning in my premium classes at Market Scholars as well. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.